Hello and welcome. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the short edition of our first quarter 2021 quarterly review. We're going to look at the past performance and some of the performance drivers of the past quarter. Thank you for watching. If we look at the performance summary table that we usually show you every quarter, there's three things that we want to highlight. The first one is the fact that the Canadian market is up 8%, which is really a complete turnaround from previous quarters. And the NASDAQ heavy, or I should say technology heavy NASDAQ composite index, while posting a positive performance, it was one of the worst performers. The worst performing asset were bonds, with a minus 5% return for the quarter. In these low interest rates environment, we're really looking at basically 2 years of interest income to make up this loss. So it's a substantial loss. The other interesting and the loss was really driven by the rise in interest rates. So as for an illustration, we see the rise in interest rates on the 10-year government bond of Canada from 0.88% at the end of December to 1.57%. So investors are locking in 1.57% for 10 years when buying the 10-year Canadian bond. In the US, they're locking in 1.74%. The other interesting thing to note is the difference between 2-year bond yields and 10-year bond yields. That's called the 2-10 spread. And why that's important is it's a good indication from a bank perspective whether or not they're profitable, their loan book is profitable. And it is. So the spread has gone from 30 basis points to 1.34 basis points. So a full 1% improvement, if you will, in the margin. And that really drove our Canadian market performance, where our S&P TSX Composite Index turned in an 8.1% return for the quarter. With keeping our mantra of having an open mind about better than expected and worse than expected outcomes, we're going to look at some of the variables that we think bear watching. The first one, certain regions are still in a lockdown. So if you're more pessimistic, you would be very much worried about this, and there's some truth to that. The other negative or pessimistic worry that are on investors' minds is the new variants that are coming in. Are they more virulent? Are they more deadly? And that impact on obviously the lockdown situation globally. Because asset prices have risen so much, we've had this wealth gap that continues to widen between the people that own assets and the people that rent assets. And so this wealth gap will continue. We can't have an economic boom or rebound that is broad-based if we need everyone to participate in this rebound in order for the rebound to be sustainable. And obviously political turmoil, public fatigue around health measures, and the more we have public fatigue, the less we have adherence to the health measures. On the optimistic side, vaccines are a reality. Completely unforeseen 12 months ago. The number of jurisdictions that are reopening, thanks to these vaccines and these vaccination efforts, the number of jurisdictions continues to open. Liquidity. There's tremendous amount of liquidity in the economic system. And so that's a good thing. If we remember back to 2008, 2009, when the banking sector was on the verge of collapse, there was no liquidity. And so asset prices effectively melted. Government stimulus, which is also a good thing from a economic perspective. You want to make sure that most economic players can have still some sort of economic activity level. And finally, improved operations. Out of this pandemic, out of this uncertainty, many sectors have improved their performance. Many companies, large and small, have accelerated their take-up in technology tools that have made them better operators. And that will stay with us post-pandemic. And the path back to normal. Again, if we could look back 12 months ago, the path to normalcy was unclear. It was foggy. Now at least we have a direct path thanks to vaccination efforts, We know how lockdowns work. We know people now understand how to operate in lockdown economically, and investors, liquidity, all of these things we know how to operate in this path to normal. And also new jobs. A lot of new jobs will be created out of this pandemic and will create new opportunities. We'll round up the video by showing some of the headlines that hit the news wires, if you will, or the web in the past quarter. So really we're looking at COVID vaccine rollouts, we're looking at some of the global chip challenges around supply. Obviously the Suez Canal illustrated or compounded a strain in terms of logistics, and obviously we're starting to talk about inflation. These are some of the headlines that really drove the performance of some of the sectors in the first quarter of 2021. Remains to be seen whether they'll continue to be with us for the rest of the year. Thank you for watching. This concludes our shorter video. The goal remains to own great assets, purchase them at reasonable prices, and limit the risk of the assets that we do own when they get out of hand or vastly overvalued by either selling them or trimming them. That approach, we remain steadfast. As always, thank you for your trust in managing your investments, and we are always looking to hear from you and look forward for the opportunity to meeting you in person when we can. Thank you so much for watching.